Hey founders, Kirk Mitchie here. Hey, we thought we would do our end of year update, our Q4 update when Q4 is almost done rather than waiting until January and let you know what happened. So we're right in the middle of it. We're active on two deals and coming to market with two others, all sort of broadly professional services of some sort, kind of B2B for the most part, a little bit of B2C. I have no real idea of whether our boutique investment banks level of activity is greater than or less than other investment banks. We talked to some who've gone pencils down in most areas, and we're talking to others that are really, really busy. Here's what we're seeing for the most part. First of all, private equity has all the money. Private equity can now outbid strategics. So if you're a founder and you're thinking your ideal exit is to a strategic buyer who might give you more cash, it is still true that strategics tend to have cleaner deal structure in many cases, but they can't outbid private equity anymore with their balance sheets and borrowing power. So you need to have private equity involved, even if it's just to keep the strategics honest and hope to get, maybe a higher price and better terms from the competitive tension. What we're seeing from those private equity investors is that they continue to all essentially be looking for the same deal. X to Y amount of EBITDA, recurring revenue, low customer concentration, growing business where the founders are completely unnecessary but still willing to stay involved, no capital expenditure required, no cyclicality happening. In other words, they are all looking for the same deal. And that's relevant in the sense that, one, if you aggregate all of those search funds, holding companies, independent sponsors, and all the different kinds of private equity firms out there, you're talking probably about a group of investment firms that are larger than the number of stocks on the New York Stock Exchange. It's ridiculous how many of them there are out there and how undifferentiated they are. Now, the good news for you is that whatever your business traditionally looks like, start to move in the direction of or set things up so that when your conversation happens with these private equity firms, you're aware that they're looking for highly recurring or at least reoccurring revenues, maybe highly recurring or reoccurring customers if you're in more of a project-based business, so that your revenues are not as recurring. Think about those themes, recurring, reoccurring. The other thing to think about is that it used to be that once you got up to $1.5 million, $2 million of EBITDA, you were in the range that a lot of at least lower middle market firms would be doing deals. Now it's creeping up. It's kind of 3 to 5 million of EBITDA. You can still get deals done at the $1.5 million to $2.5 million of EBITDA. But you're definitely going to be a tuck-in or an add-on, or you're going to be more attractive to search funds and independent sponsors who don't see as many of the great opportunities. So they might not have capital, but they're eager to do deals that are a little bit of, what in the bond world they call off the run. Coming back for a second to those kinds of things they're looking for. If you have high customer concentration or high supplier concentration, before you go to market, you need to start to diversify that. Get on a path to diversify that. As always, professionalize your financials. It used to be that you didn't need CPA prepared financials. You didn't need a seller's quality of earnings. These days, to get any significant traction now, even with independent sponsors and some of the search funds and family offices, you need to have CPA prepared financials. You can do a deal without them, but expect to have really slow or tough going in financial due diligence. So recurring, reoccurring revenue, obviously profitability has to be good or improving. Growth is a positive, especially if it's sustainable and persistent. Choppiness tends to be not something that most of these financial buyers like. Cyclicality is something they would rather not tolerate. And I'll say this about this smartest group of sheep-like animals that tend to move into an area all at once and then bail out of an area all at once. It's not that they're not smart, that they're trying to find these same deals. It's that they're not operators. They're not entrepreneurs. They've never lived with the kind of existential risk you do of knowing that every 2 weeks you got to come up with enough money to make payroll, and constantly you got to be responding to disappointed customers or customers that want more from you. or hiring ahead of your growth, or hiring just in time for your growth, or anticipating a supplier going away. These financial investors, they don't know anything about that. They think they do. They don't. They're not you. They're not operators. They're not going to fully understand you. But some of the best of them can appreciate you. And the other thing I'll tell you is that, so they've got a lot of capital. They're still looking to do deals. They're very picky these days. They'll tell you they want to see everything. On the other hand, they're trying to find some narrow areas. The things that are hot, professional services, accounting, engineering service, property management, and on and on and on. Think of people-based businesses that have large enough scale, large enough growth that you can kind of bolt a bunch of them together, create a national or global presence. Those things are all hot. They continue to sustain things like landscaping, HVAC, what they call field services. So call these kind of trucks and clipboards businesses, dirty fingernails businesses. Those are still hot. They continue to do really, really well. Certain kinds of healthcare services, especially if they don't have reimbursement risk, which, by the way, you can't really be in healthcare without reimbursement risk, but don't try and tell that to a healthcare-focused private equity firm. Anyway, healthcare services, healthcare tech, kind of the companion or adjacent things away from the actual care, they love those things. They're also looking for some kind of nichier areas. But look, you've been in your business for 20 years or 40 years or 3 generations. There's no way you're going to configure yourself into whatever the currently most popular thing private equity buyers are looking for is. So just keep running your business well. You can't do anything about whether they're picky. You can't do anything about sentiment, but you can decide about whether you'll go to market or not. If you have a manufacturing business with your manufacturer in China, this is probably not a great time to go to business. The tariff stuff notwithstanding, a lot of folks are going to wait to see what happens between Costco and the administration in terms of suing them around tariff rebates. But suffice to say, there's some uncertainty there. So this is probably not an ideal time there unless you've got a really, really aggressive and interested buyer. The last piece, there's still a ton of debt capital out there. Banks are still lending on buyouts, non-traditional lenders, private credit, they got money by the truckload. And so then the other thing is that there's still at the low end of the market, SBA financing, there's still plenty of capital out there to do deals. There's no regulatory headwinds whatsoever from this administration. Doesn't matter unless, of course, you're, Netflix and you're thinking about buying Warner Brothers Discovery and Paramount's your co-bidder and you've got all that stuff going, then there's some regulatory stuff. But otherwise, there's almost none, especially not in the area of the market that's kind of below 500 million. All right. So it's still taking 4 to 9 months to get deals done, but the private equity firms are out there. And if you've got a competitive deal, if you've got a company that can be put in front of a dozen of them who are all really, really excited about the business, you can probably push for shorter terms, and you might be able to also push up valuation and the seller terms, if you will. So still continues to be a good time to go to market. There's still enough strength from the stock market and enough tailwind from economic growth without too much headwind from creeping unemployment or, the invasion of AI changing anything right now. Sorry for the long-windedness, but there's a lot going on in the markets right now. Okay, have a good year end. Happy holidays. Thanks.